money. It's taboo. It's complicated. Or at least it seems to be. A lot of personal finance and investing is surprisingly simple. Understanding a bit of the language and some of the core components makes understanding it a lot easier and makes you feel a lot more confident about personal finance and investing. Hi, I'm Marcus Rogers, and this is Learn Wealth, a channel dedicated to making personal finance and investing simple and practical. If you're new here, please consider subscribing. In this video, I'm going to go over 7 basic terms and concepts to help you better understand and better make use of your money. At the end, I'm going to give a few book recommendations that I've read and really enjoyed and have set me on the path that I am on now. I often hear people say that I'm lucky that I know a lot about money. But honestly, I'm lucky that I'm interested in learning about money. I do have a degree in accounting and economics, but most of my learning comes from reading, from books, from articles, from watching videos of what top financiers are doing, and more importantly, watching their actions of what they actually do. If I've learned anything, it's that while it is very complex, often the principles and what an individual needs to succeed financially are actually quite simple. So in this video, I'm going to go over those. Most importantly, I want to remind people that you have to be in control of your money and not let your money be in control of you. I talk a lot about reducing expenses and cutting costs, but the point is not to be frugal and miserable. It's to be understanding where your money is going and spending it on the things that matter most to you and setting yourself up for spending on the things that matter most to you in the future as well. I don't not do things because they're expensive. I've actually got some very expensive habits like traveling and sailing, but I'm frugal in other areas of my life so that I can enjoy those. And investment and fun is never lost. The first concept is treating your personal finance like a business. So in the most intro of accounting classes, you look at these really simple equations and it's income minus expenses equals profit. And you kind of need to look at it the same way in your personal life. How much are you making? How much are you spending? What do you got left over? And if you don't have anything left over, then you're not going to have any money to save or invest, which you need to do. So I think honestly the most foundational place is a budget, and if you haven't made one yet, I've got a video on it and I'll link it in the description below as well as at the end of the video. Number 2 is thinking about the long term, and it's easy to think about how a budget works on a month-to-month basis or how you get a paycheck and then you spend it for the next couple of weeks. But honestly, in personal finance and investing, you need to be thinking about a few important different time horizons. So that 2 weeks to a month is really important in a budget. You also want to know at the end of the year, what did you make and what did you spend, how much you got left over. But then you also want to be looking at out on the medium term, 3 to 5 years. What are your financial goals? Do you want to buy a house, a car? Do you want to go on a vacation? It takes a considerable amount of time to save up for those things. Beyond that, then you want to be looking at, retirement, and then not just retirement, but are you going to be able to leave anything for your family? So these are timelines that are in the decades. And by thinking about money in that way, that it's not just come and go, get and spend, start thinking about it for the much longer term and know that all of these money goals do take time. You're not going to save up for a house in a month. It's going to take a long, consistent time of putting money away for that. And that's okay. That's just how it goes. Things are expensive. The third thing is the value of money and opportunity cost of money. And basically all that is, okay, you've got $10. What is the opportunity cost of that $10? In other words, what are you missing the opportunity to spend that $10 on by spending on something else? So if you spend $10 on a beer at the bar, you're foregoing the opportunity to save that $10. And why I put the value of money in with this one is that you can't just look at it as $10. You do that 10 times, let's say, you've got $100 now, and then you invest that $100 in 7 or 10 years, it's actually going to be worth $200. It will compound over time. And by the time you go to retire, it could be multiple hundred or even $1,000 worth of money, when really it just seems like $10 at the time, but then you do that a number of times and you invest it, it really adds up. And when you start to think about money like in this way, you might start to reconsider a extra few $100s or $1,000 to get an upgrade on a car or something. When you multiply that over investment returns over many years, it could actually turn out to be tens of thousands of dollars. And just remember that when you're buying things, you're not just buying that thing, you're forgoing the opportunity to do other things with that money, which some of those things, like investing, can multiply over time. And again, remember, it's a long time, but it will happen. Now, relating to that is number 4, and that's compound interest. It's a term you may have heard before, but what this means is, so you invest $1,000, let's say, and you make some interest on that. So let's say it's a 5% interest. At the end of the year, you have $1,050. Now, how that compounds is that the next year, you don't just make interest on $1,000, you make it on $1,050. So now you're making a little bit more, and the next year a little bit more and a little bit more. Now, these will seem incremental over time, but what you'll find is that it really starts to ramp up in an exponential way. And that initial $1,000 turns into a lot more. There could come a time in the future where the interest is $1,000. Now, that would take a really long time, but it illustrates the point. Number 5 is paying yourself first. And I've talked about this in some other videos before, but the basic idea is that if you want to guarantee that you have some money left over at the end of the month to invest and put to work in profitable ways, then if you, as soon as you get income, right off the top, take your 15, 20%, whatever you can afford, even if it's 5%, that's a fine place to start, and take that aside and put it away right away. And honestly, the difference between, say, $10 and $9, it's not that big of a difference. It's the difference in buying the name brand versus the white labeled brand. You can still get the same things. It's not going to be that much of a difference. But you can take that money that you've paid yourself first with, and you can do things like invest it. You can gain compound interest. Number 6 is affordability. And often people think that they can afford things if they can pay for it right now, or even worse, if they can get credit to pay for it. Now, the thing you got to understand, when you go into the bank and want an auto loan or a mortgage, they're going to tell you the absolute maximum amount that you can borrow, and they want you to borrow that much because they make more money. It is regulated, but they are going to offer you as much as possible so that they can make as much as possible. This does not really mean that it's a great decision for you. Now, if you go get the most expensive house you can possibly afford, and an expensive car, and you build an expensive lifestyle, and then all of a sudden an economic shock happens, or you lose your job, or something like that, you have to take a pay cut, all of a sudden you can't afford these things, and you're gonna owe a lot of money on them, and you're gonna need to find ways to afford them, or you might have to sell them at a time that they're not worth very much. Bad things tend to happen at bad times, so you can't necessarily take money out of investments because they might be down, or you might have not even had money to invest in the first place. So I don't want that to be too doom and gloom, but the point is that just because you have the money or the credit to afford something, it doesn't necessarily mean that you should go buy that expensive, lavish thing, and that by scaling back what your lifestyle costs a little bit, you're going to be able to set more aside, save more, invest more, be a lot more comfortable. And when bad things happen, then you have some cushion and you're not pushed to the extremes to have to be able to afford your lifestyle. Number 7, the last thing I want to talk about before I give the book recommendations is debt. Because debt is a big, scary word that I think is fairly misunderstood. I look at debt as being both good and bad. There's both kinds, but it really depends what you're using it for, what it costs you, and things of that nature. So on the one hand, you've got bad debt, and I will call this consumer debt, credit card debt, debt that you're incurring to spend on things that you consume. So putting money on your credit card to go out to a restaurant when you don't actually have the money to pay for that. You're going to now pay interest on that, and really you have nothing to show for it. Also, credit cards charge like 20% interest, so you're going to be incurring a lot of expenses on that interest. On the other hand, there's good debt that will get you an asset or an education or something that allows you to make more money on. So people that invest in real estate, they tend to incur a lot of debt to buy the apartment building or what have you. But they have a physical apartment building. Worst comes to worst, they sell it and they've basically probably got their money back as long as it was a good deal. But what they're buying is cash flows from the tenants. The tenants are going to pay them money every month, and they're actually making money off of this debt. It's also going to be through a mortgage of a sort, and it's going to have a much lower interest rate than a credit card. Same goes for university or college or courses or anything like that where you are gaining a skill. That is good debt, because you're going to use that so you can make more money with it. It's an asset to you. So I want you to think about that with debt. Is it bad debt or good debt? How is it repayable? What is the interest rate? And, is it a good decision to incur this debt? If you want to join me on my journey of financial freedom, hit the subscribe button. If you feel that you got something out of this video, give it a thumbs up. Really appreciate it. Now, as promised, 3 book recommendations that are really foundational for me. Number 1 is The Richest Man in Babylon. And this was written quite some time ago. The language is actually quite old. It's obvious. And they talk about gold, not money, things like that. But they set aside principles like paying yourself first, not spending all of your investment income and actually letting that get more investments. It talks about some of these really foundational principles that I think everyone should know. Number 2 is Better Than I Expected. You hear about this book a lot, and I didn't know what to expect, but it was better than expected, and that is Rich Dad, Poor Dad. And I really like what this guy does. He talks a lot about assets, and his big thing was real estate and making income from assets. But he also talks about different ways you can make money. And he's got his cash flow quadrant where he talks about being an employee versus being self-employed versus being a business owner and an investor, and all the pros and cons of those. Third is an investing book, and I really liked it. It's by a guy named Howard Marks. He's the founder of Oaktree, and which you may know is a massive investment fund and firm. But it's called Mastering the Market Cycle, and he talks about all the different governmental earnings, media, psychology cycles that all play into the larger market cycles. So, you hear a lot, it's not smart to try and time the market, and, timing the market's kind of a vague exercise. But he does talk about these different indicators that let you know roughly where you are in the regular business cycles, and that can help inform your investing decisions. Now that's it for today. I hope you got something out of this video. Have a good one, folks.